Hello everyone, we are Group 6. Today we are talking about a financial instrument, swap. What is a swap? A swap contract is an agreement by two parties to exchange or swap specific cash flows at specific intervals. Generally, each stream of the cash flows is called a leg. In practice, one leg is generally fixed while the other is variable. Swaps are a recent innovation. They were first introduced to the public in 1981 when IBM and the World Bank entered into swap agreement. Even though relatively new, their simplicity, coupled with their extensive applications, makes them one of the most frequently treated financial contracts. Unlike futures and options, swaps are not traded on exchange but over the counter, and counterparts in swaps are usually companies and financial organizations, not individuals. There are many types of swap. Today we talk about three basic types. The first one is interest rate swap. An interest rate swap is a type of a derivative contract through which two counterparties agree to exchange one stream of future interest payment for another, based on a specific principal amount. In most cases, interest rate swaps include the exchange of a fixed interest rate for a floating rate. We can see this picture to understand how does an interest rate swap work. Company A is currently paying floating, but it wants to pay fixed, while Company B is currently paying fixed, but it wants to pay floating. So Company A pay the fixed rate, at the same time Company B pay the floating rate. And then they exchange their interest rate through the bank. The bank gets profit from the bid-ask spread of these transactions. In the end, by the interest rate swap, Company A pay 9.6% fixed rate, and Company B pay labor at 0.7% floating rate. Normally, the parties do not swap payment directly, but rather each set up a separate swap with a swap dealer such as a bank. Generally, they do not exchange that asset or pay the full amount of interest due on each interest payment date. Only the difference due as a result of the swap contract. And the second type is currency swap. With a currency swap, two parties agree to exchange a specific amount of one currency for a specific amount of another at specific dates in the future. And there are three types include currency swap. How do currency swap contracts work? Let's consider the following example. Company A is a US-based company that is planning to expand its operations in Europe. It requires €850,000 to finance its European expansion. And on the other hand, Company B is a German company that operates in the United States. It requires $1 million in financing. To borrow at a lower interest rate, both companies will prefer to borrow in their domestic currencies. So Company A obtains a credit line of $1 million from Bank A with a fixed interest rate. At the same time, Company B borrows the fund from Bank B with a floating interest rate. And then A and B create a swap agreement with each other to the foreign currency they require. Currency swaps are primarily used to hedge potential risks associated with fluctuations in currency exchange rate or to obtain lower interest rates on loan in a foreign currency. The swaps are commonly used by companies that operate in different countries. And the third type is commodity swap. A commodity swap is a type of derivative contract that allows two parties to exchange cash flows which are dependent on the price of an underlying asset. In this type of swap contract, we can see this picture. There are two legs, the flowing leg, which is tied to the market price of the commodity, and the fixed leg, which is the grade upon the price specified in the contract. Swap dealers, such as financial service companies, play the role of a market maker and profit from the bid-ask spread of these transactions. They are used to hedge against the swings in the market price of the product in question. These swaps allow commodity producers and end users to lock in at the set price for the underlying commodity. And through the above content, we can summarize two functions of swaps. One of the primary functions of swaps is the hedging of risks. For example, interest rate swaps can hedge against interest rate fluctuations, and the currency swaps are used to hedge against the currency exchange rate fluctuations. And companies can use swaps as a tool for accessing previously unviable markets. For example, a US company can opt to enter into a currency swap with British company to access a more attractive dollar to pound exchange rate, because the UK-based firm can borrow domestically at a lower rate. That is my part. Thank you.
Now let's see how to invest in interest rate swaps. We can see here interest rate swap have so many potential uses like portfolio management, speculation, corporate finance, rate locks on bond issuance, or risk management. First, portfolio management. Interest rate swaps allow portfolio management to adjust interest rate exposure and offset the risk posed by interest rate volatility. Second, speculation. Because swaps require little capital upfront, they give fixed income traders a way to speculate on movements in investor rates while potentially avoiding the cost for long and short position in treasuries. Third is corporate finance. Firms with floating rate liabilities such as loan linked to LIBOR can enter into swaps where they pay fixed and receive floating. Fourth, rate locks on bond issuance. When corporations decide to issue fixed-rate bonds, they usually lock in the current interest rate by entering into swap contracts that give them time to go out and find investors for the bonds. Once they actually see the bonds, they exit the swap contract. Last, risk management. Banks and other financial institutions are involved in a huge number of transactions involving loans, derivatives contracts, and other investments. We can see the risk managing application of swap strategies here. It can be used to adjust the duration of a fixed income portfolio or create and managing the risk leverage floating rate notes or invest floaters. It also can convert a loan in one currency into a loan in another currency, or to create and manage the risk of a dual currency bond. Diversing a concentrated portfolio, changing an asset allocation between stocks and bonds, or reducing insider exposure strategies and application use swap and so on. Here we see the risk management and swap derivatives. Swaps are used to manage risk a couple ways. First, you can see swaps to ensure favorable cash flows, either through timing or through the types of assets being exchanged. The exact nature of the risk being managed depends on the type of swap being used. The earliest way to see how companies can use swaps to manage risk is to follow a simple example using interest rate swaps. The most common form of swap. Here we assume that company A owns $1 million in fixed rate bonds and earn 5% annually, which means $15,000 in cash flow each year. A thinks the rate will rise to 10%, uh, which will yield $100,000 in annual cash flow. It is $15,000 more per year than their current bonds holding. So what will A do? A go to a swap broker and exchange not the bonds themselves, but the company's right to the future cash flows. A agrees to give the swap broker the $15,000 in fixed rate annually cash flow, and in return the swap broker gives the company the cash flow from variable rate bonds. It was $1 million. Company A and the swap broker continue to exchange this cash flow over the life of the swap, which ends on a date determined at the time the contract is signed. In this example, swap help A manage its risk by making available to the possibility of altering its investment portfolio without the costly, difficult and sometimes impossible process of actually rearranging asset ownership. As a result, A makes an additional $15,000 per year in bond returns. Of course, like with many investments, the company could also lose money if investor rates were to decrease rather than increase as they project. Let's see another example: revenue generation and sub-derivatives. Here we assume company A has $1,000 and believe that the Chinese yuan is set to increase in value compared to the USD dollars. A gets in touch with B which in China. B just happened to need a US dollar for a short time to fund a capital investment in computers coming from the US. These two companies agreed to swap currency at the currency market exchange rate. We assume here that $1 equal to 1 China yuan, and the market is stable. They swap $1,000 for 1,000 China yuan. The swap agreement states that they will exchange currencies back in 1 year at the forward rate. Company B needs the currency but doesn't want to pay the transaction fees, while Company A is speculation on the change in exchange rate. If the China yuan were to increase by 1% compared to the USD dollars, the Company A would make a profit on the
Hi, I'm Deepa Nagarajan. Would like to continue on does financial instrument swap relate or can relate to international finance or foreign currency risk? Before I go through how financial instruments swap related to international finance, I would like to give a simple definition on international finance. Basically, international finance defined as the monetary transactions deals between two countries and the concepts like exchange rates, interest rates, FDI, and FPI. When it comes to financial instrument swap related to international finance due to monetary transactions from different countries that hedge the foreign currency risk. Although there are various types of financial instrument swap exist in global market, yet currency swap is typically related to international finance. This is because currency swap involves exchange of the principal amount and interest payments denominated in different countries. Apart from that, fluctuations in exchange rate inevitably cause foreign currency risk to the investors. In other words, adverse changes in foreign rate not only affect returns of a portfolio with heavy international exposure, but also businesses across the globe exposed to currency risk. This is typically when income earned abroad is converted into the money of the domestic country, and when payables are converted from then domestic country to the foreign currency. However, the currency swap is one of the parameters to hedge the risk associated with exchange rate fluctuations. In addition, currency swap is not only hedge the risk associated with exchange rate fluctuations, but also ensure the receipt of the monies and achieve better lending rates. For instance, an American company might able to borrow in United States at a rate of 6%, but requires a loan in rand for an investment in South Africa where the relevant borrowing rate is 9%. At the same time, a South African company wishes to finance a project in the United States where its direct borrowing rate is 11% compared to a borrowing rate of 8% in South Africa. As a result, the American company can borrow US dollars for 6% and then it can lend the funds to the South African company at 6%, while the South African company can borrow South African rand at 8%, then the lend funds to the US company for the same amount. This is how both parties benefited from the other's interest rate through a fixed for fixed currency swap. This example clearly argues how two different countries benefited from currency swap to mitigate their foreign currency risk. Nevertheless, making this point way stronger, a current issue relevantly support how swaps exist in global market. For example, recently Sri Lanka signed 3-year USD 1.5 billion, equivalent to 10 billion yuan, currency swap deal with China to be used for fostering bilateral trade and direct investment between the two countries. This agreement signed between the People's Bank of China (PBOC) and CBSL, Central Bank of Sri Lanka, which approved by Reserve Bank of India. This agreement arises due to Sri Lanka is experiencing a difficult pace with COVID-19, especially its USD 4.5 billion tourism industry, which was already collapsed by the Easter Sunday terror attacks in 2019. Meanwhile, China views Sri Lanka as a key player in Beijing's aspiring project Belt and Road Initiative (BRI). This current issue clearly supports the point that both Sri Lanka and China entered into a swap agreement in a way to benefit their domestic country's mission. Therefore, financial instruments swap strongly proves that still investors rely on swap agreement to mitigate their foreign currency risk and dominate their international financial market.
Hello, my name is Bao Jingwei. My metric number is GS59216. And after our group member introduced a lot of about swaps, and then I will do the last part, which is related articles. And the article I choose, the first one is effects of interest rate swaps, and the second one is interest rate swaps and corporate default. As my group member just said, An interest rate swap is an important type of swap, and by now they are among the most popular derivative contracts. As with other derivatives, it has the ability to affect the inter-period allocation of cash flows through change in interest payment. So I choose this article to figure out what's the exact effect of the interest rate swap. So let's get into the first paper. The first one, which called is effect of interest rate swaps, and the reason I chose these articles is this paper examines the effect of interest rate swap on the firm and identify characteristics of firms that use interest rate swaps. Reporting finding consistent with interest rate swap being used a risk reducing instrument. Relative to non-swappers, firms using swaps are more likely to experience decreased cash flow variance in the 5-year periods subsequent to swap initiation. In addition, firms that engage in swap are found to be larger and more highly leveraged than a control sample of non-swappers. Dividing their sample based upon type of swaps, this paper found different characteristics explain different type of swaps. In particular, this paper found evidence consistent with swap from variable to fixed interest rate being engaged in for risk reduction, for example, hedging purpose. And there is 4 motivation for swap in this paper. The first one is hedging, and the second one is comparative advantage. And about the comparative advantage, one asserted motivation for swap revolves around comparative advantage, whereby certain companies can obey certain types of financing more cheaply than others. This comparative advantage argument implies risk-less arbitrage and has been challenged by many scholars. The third one is asymmetric information hypothesis. And the fourth one is size and leverage. The sample selection, we can see here the database the author used is a national automatic accounting research system. And the firm sample is using the firm engaging in swap from 1984 through 1989. And the sample selection for this article, we can see the sample distribution by type, year, and industries. And on this table, we can see the panel 1, panel A is by year and type of swaps, and panel B is by SIC code and type of swap. On this page, we can see the descriptive statistics and mean different tests for swap variables. And on the panel A of this table, it provides some statistics on the swap themselves, while panel B provides statistics on swap and control firms. This table also provides some information on the characters of the swap and control firm. And then this paper do the empirical test. First is on the effects of swap. The first test examines examines the effect of the swap on the time series variance of cash flow and accounting earnings. This table shows that swappers are more likely to experience decrease in their cash flow variance than non-swappers. This is consistent with swaps being used for hedging rather than speculative purpose. Surprisingly, however, the swap had no effect on the variance of earning. And on the second part of the empirical text is about the characteristics of swapper firms. And here we can see the model. By using this model, the second test examines the characteristics of swapping firms by comparing them to a group of firms matching on industry and size that did not engage in swap. And we can see in this table, it finds swappers are significantly larger, more highly leveraged, have a lower variance of stock return in year periods to swap, and a lower market to book ratio. The first two results are consistent with swapper having more opportunity and potentially getting a greater benefit from swapping, while the later two findings are consistent with the swapper being less risky and slower growing. And on the summary and conclusion of this article, this paper shows the effect of interest rate swaps on firms and examines the characteristics on firms engaging in swaps. It found that firms engaging in swaps subsequently have lower cash flow variance than non-swappering firms, a finding consistent with firms engaging in swaps from risk reduction or hedging purpose. Then let's go through the second article, the second paper, which is interest rate swaps and corporate default. And this paper study firms' usage of interest rate swaps in a model economics driven by aggregate productivity stocks, inflation stocks, and counter-cyclical idiosyncratic productivity risk. A key ingredient of this model are firms that with long-term projects that are financed with a short-term debt. This market incompleteness highlights the role played by interest rate swap as a tool to manage risk associated with interest rate, inflation, and productivity. So in this model, swap generate only small economic gain from the typical firm. And in this paper, the author used the quantitative analysis, and is the quantitative analysis, which include the parameterization, model implication of for swaps, and consequence and value of swap usage. The conclusion from this analysis is that swaps do not create a lot of value for a typical firm in this model, but because swaps are cheap, it nevertheless makes sense to use them. To the extent that some firms have relative high probability of default, they would attach a higher value to the insurance provided by the swap. So in conclusion of this paper, it considering the impact of swap usage, they found that swap has essentially no effect on firms' really investment behavior. The cost of debt financing is somewhat reducing the swap. Overall, they found only small economic gain from the swap usage. So let's compare these two papers. We can find the similarity of these two papers is these two papers both believe that company use the interest rate swaps as a tool to manage risk. And the difference is also easy to see. And we can see the difference is considering the impact of swap usage. The former found that firms engaging in swap subsequently have lower cash flow variance than non-swapping firms, a finding consistent with firms engaging in swap for risk reduction or hedging purpose. While the later finds the swaps have essentially no effect on firms' real investment behavior, and only small economic gain from the swap usage. So this is the compare for these two papers. And thank you for listening.